The broadcast is now starting. All attendees are in listen-only mode.
Hello, Warriors. How's everyone doing today? So the character of the markets changed a little bit. My friend Brian Twomey says it's a reset that happens every 10 years. He brought up Euro Yen. Want to welcome our viewers from investing.com. 2019 is going to be quite a year for equity investors. It's our mission to keep you informed on not just equities, indexes, but the fulcrum of the wheel, which we believe is currencies, and still at this point being the dollar, which is still the reserve currency. I think that yesterday's raid points out the need to reduce leverage. Everyone who said, and that included a lot of us, that, boy, we sure hope volatility increases in 2019. Well, be careful what you wish for. So we had spikes in everything. I haven't seen this happen in FX in a long time. I think it was mainly reserved for precious metal markets, which they did these raids all the time, especially while it was bottoming. And you could see it still even happens in silver. See this and see this. So I thought that bear raids were reserved for precious metals. They're not as deep as a market as FX and currencies. And it wasn't just limited to the yen. You know, if you're long the Aussie, there's no way any reasonable stop survived yesterday. So I guess the question is now, what do we do with wicks like this? I've learned from my partner, Steve Volge, to begin to ignore the wicks, that they're aberrational. So he doesn't include them in his trend lines and his other work. And you just kind of stick with the bodies and maybe the candle after the big wick. But as you can see, it happened everywhere. And I'm sure a lot of traders, both institutional and not just retail, were shaken up by this. Actually, in the end, I was looking for 108, 107 and a half. And as you can see, during the real trading, we're kind of in this area here. So now what you have to do is kind of let the ranges fill out this type of action here. I really don't like to trade these markets until I get a few days action and multiple candles to see what carves out a legitimate range. Those types of aberrational moves, to me, of course, are real. Whether or not they're legitimate for price interpretation, that is open to interpretation. So I just want to show a couple of markets that I think are knocking on the door. We've been talking about EG for quite some time, and there was an excellent pullback for Euro Pound. But you have to be quick on the trigger and do it on a shortened session down here. So if you look at the daily or the weekly, this was kind of an area that, we were looking for. I thought there was a chance that we might get down to the, here it is. It was right here on New Year's, down to 88 and a half. But the main feature I want to show is this horizontal line here, which would be a breakout. Still possible if we don't get through for one more sell-off into here. But actually, this breakout, should we achieve it, will then project up to the 94 level, which is a level that, God, we've been talking about since for a year and a half, or I've been talking about that this whole formation looked incomplete to me because of, I really believe in the number 3 and 3 drives. And if we break out here, coincidentally, it's about a 350 pip move would take us up towards 94. I think it's going to happen. So, what do you do now? There's a possibility that we're not going to pull back much deeper than here. Thought that there might be a chance that maybe we get, after this, maybe another C wave down. Doesn't look like that's going to happen. Not a bad area to probe it here in advance of a breakout, but you're not even late if you wait. You're not late if you wait. I like that. So you could have confirmation of a breakout back over 90.90, or you could try and get an edge into the breakout and then perhaps manage the risk under this low, this little minor pullback that we had on the first full trading day of the year. Want to point out a couple of other markets, Bitcoin. I know Steve still thinks there's higher numbers, maybe to 4,000. I'm not sure if that's going to happen, but I would love to see a pullback one more time to the 78.6 level around 3,300. This is starting to look like we had some type of bottom. I'm not a waiver. Greg will be here, and I think I'll ask him about Bitcoin, that we could have had 5 waves up on this initial move. So this could be corrective for a wave 2 down here. I'd be very interested in it. Looking at the gold spiked after all that volatility here. It's still not confirming. It's gotten up to 1292. Also, I want to caution everybody, how are you, that we have NFP tomorrow. So just curious, who did not pocket some 1,000 pips yesterday? I'm sure that some people were the wrong way and were liquidated on that spike, Rob Jean. So poor audio. Okay, you may want to log in, log out. At least you could hear me now. You may be able to hear me better if you do that. And, gold has reached a 61.8. We spiked on the volatility here. If the NFP wasn't here today, I'd be trying it. Caught a little of this downside yesterday. We're still not confirming the new high in gold. As you can see, the RSI did not make a new high in the 1 hour. I really doubt it did on the 4. It's even more. You can see we've been diverging for, gosh, all the way back here when gold was trading 1280 or so. I'm going to wait for the NFP and react to the reaction. Something that I teach is go very lightly into major numbers. It's going to be a big number for all the markets right here, because I think the market's going to hope for not a real strong number, or something within the headline number that could give the Fed rationale to, pull back their horns, their hawkish wings, fold them in, and give the market some relief that maybe Fed rate hikes are at least on hold for a while. So the NFP tomorrow is very important for everything. So don't go heavily into the NFP trying to predict how the market's going to react. React to the reaction afterwards. So you go through all the instruments that you trade and you have all your levels ready. And then after the number, if levels act like magnets for you to take action, maybe let 15 minutes go after the NFP. And look at a 15-minute candle. God, I learned that from Valeria Bednarik at FX Street when I worked over there for 3 years. She used a 15-candle range after big news events on the NFP. And after that candle, what you do is you look at the high and the low of that range, and then you go with whatever direction the market goes outside of that range. So that's just a little tip. I've learned a lot of things from a lot of people along the road, and you don't know how much I've learned being part of this team at ForexAnalytix. The only way you would know is if you became a member and checked it out and immersed yourself in our analysis, immersed yourself in our chat room, immersed yourself in Paulie getting up very early to service European clients. So he's getting up at, I think, 1 in the morning. So you can catch Paulie on the European crossover every day. Also, it's a good time to reassess your broker if you're not happy with it. These are the guys to talk to. You get a hold of Trent, or Justin at Forest Park FX so that you could see the forest from the trees. And here are the trees. Every broker that they have relationships with. You could set it up if you're outside the U.S. for it to reimburse your subscription price. And if you're here in the US and you're not getting rebates on your trading, that could, make a car payment for you or pay for life insurance or just extra money. Money for nothing and chicks for free, dire straits. So I don't know about the chicks for free or money for nothing, because there's a lot of effort that goes into FX trading. So I don't know. I sang karaoke and I had to pay. So the chicks weren't for free. I had to pay for my meals and everything. So never really had a dire straits experience. But I bet Blake has.
No, I haven't. And good morning, Dale.
How are you, buddy?
Good. We have just actually just a couple of minutes till we have ADP non-farm, our private sector jobs report. So I do want to cover that here in a moment. But man, I'll tell you what. You were talking about the volatility, and we got an extreme amount of volatility yesterday. If you saw what had happened in the yen pairs, I mean, you have to imagine this is the dollar yen. This is yesterday's close. So we closed at almost 109 yen and we dropped below 105. Now,
when's the last time you saw that? Have you ever?
Well, no, since the financial crisis, I say 2007, 2008. So I mean, it's been like 10 years since we've seen that type of those types of moves, where they're really illiquid. And it wasn't during normal business hours like back then. I mean, back then the market was, being sold aggressively throughout the course of the day, and we'd have 300 pip moves. This was an algorithmic move, and as soon as the algorithm stopped, the bounce back came. There was obviously a lot of people forced liquidity there, and when it's happening during non-business hours, the most important thing to do is not panic. Everything's bounced back now. The dollar yen is not. I mean, it's down from where we closed. But a lot of that selling has, abated, and there you can point your finger at a lot of different things. There's people that are blaming it on Japanese exporters that wrote puts at 105 at the end of the year. Now that their hedges are knocked out, they've got to be selling dollar yen at higher levels because they got to, protect themselves with their long side positions. You've got people blaming it on some exotic crosses like the Turkish lira yen, which was a massive move. And the Aussie yen, people saying it was a flash crash in the Aussie yen, which you can see the Aussie yen was just, a massive amount of move. But look even the pound yen. The pound itself got demolished. We broke through trend lows yesterday and bounced back, and same with the Aussie. The Aussie absolutely got creamed, and we're back, near closing prices. Now, we have like just a couple of minutes before ADP non-farm, and this is now the problem because we are expected to create 179,000 jobs. So that's what Forex Factory has here. Let me see. Let me grab Bloomberg. So Bloomberg, as you can see, the ADP is looking for 180,000. Okay, which I'll keep up here. Just so we have it. Whoa. Wow, dollar Canadian has just slumped through broke down. It's breaking down through this trend line here. This is actually a pretty important trend line that we're taking out, which is good because I'm short the New Zealand Canadian. So this is good news for me. If anybody's short the New Zealand Canadian, we've got some pretty good trade going on right now. Okay, so which is good. Now heads up for the ADP. Let's go. See, the question is if the number's really weak, what do you sell? Do you sell the dollar yen here? I don't know. Let me get the Bloomberg number. All right, here we go. So 271,000. That's a huge number. Huge number.
Are we sure it's not a typo? 171.
I don't know. That's a huge number. Look at the dollar yen spiking up right now. That's crazy, right? That's a big number. And I mean, this is going to be really positive for the market. I mean, think about all the people that just got, washed out of their dollar yen trades and all their yen trades. I mean, that's a big number right there. Wow. Now, I would expect that you see some selling in dollar yen above 108. So anything from 108 to 108.10, you're probably going to find some sellers now. So just be careful of that. That's what I would be thinking. And that, I mean, boy, what a big number. Now, the last month was revised down here. I should show you this. Last month was revised down to 157 from 179. So, but still, that's a pretty stout number. Some people are going to be thinking twice about non-farm payrolls that come out tomorrow. So that's something to chew on. Now the euro dollar was pretty unmoved because you're seeing a move up in the euro yen. So the euro yen spiking higher. Let's see if we can get this dollar yen above 108. I'm more interested to see what the dollar yen does above 108. I think 108 to 108.15 is going to be pretty key resistance. You can see this has been a really big level for going back to the way back. I mean, we're talking about 2017 numbers. So seeing us move above 108 and what we do up here is going to be very, very interesting. What's also interesting is even with the strong number, the dollar Canadian is moving lower. It spiked up and then it's come right back down. And as you can see, crude oil is bouncing too. So that's helping that dollar Canadian move lower. But and the euro is not really moving. I think a lot of these are the yen pairs. I mean, look at the Canadian yen. Canadian yen is spiking up. Aussie yen, recovering. New Zealand yen recovering a little bit. Dollar yen's trying to recover. So really, really big numbers here out of the U.S. And actually, I would argue that the more important number is going to be the ISM numbers here in an hour and change. So some big stuff. And hey, Stelios, how you doing this morning?
I'm very good, Blake. Trying to make sense of what's happening.
So we all are, right? It's like you woke up to this crazy move. So what do you say?
Well, this is I think you described it very well. I mean, this is the short-term move in a very liquid part of the time of the day. It's purely driven by algos. We've seen what they can do. They all grab, they all hop on top of each other after an initial move, and then the move gets exacerbated. I'm trying to think about all this and think about how all this translates in a longer term time frame. And obviously, this is, in my opinion, this is noise in terms of what do I think fundamentally is happening. And the thing that really has me a little bit worried now is the fact that the market is pricing nothing for the Fed for the next year. Literally nothing. Like Fed fund futures are flat for the next 12 months or so. Actually, they start to go slightly negative. So, we are at the point where we're pricing the Fed doing nothing. What's the risk? If you say, "Oh, I'm bearish the dollar, I'm bearish the U.S. economy," what are you risking if you are, say, short the dollar? Where you're risking obviously the possibility of the Fed coming out a little bit more hawkish than expected, or maybe delivering one hike in 2019, which I don't, might happen, might not. It's very volatile at the moment, very fluid, I think. But the question is, if you're short the dollar, really you're betting that there's going to be there's going to be a recession in the US, which is possible. But are we there yet? All the leading indicators are changing. They're moving. They're turning actually. But is it time for that? Next year. Steve obviously thinks so. He said this quite some time ago, and actually I have to give it to him, because when he started saying it, the market was pricing 2 or 3 hikes. So he's caught that really well. But the question is, from now, going forward? What do we think? Personally, I think that the U.S. economy is going to start turning. Will it enter recession? I don't know. It's a tough call. So my point is, if you're short the dollar here, you're betting that there's going to be a recession in 2019, which might not happen. So I'm at this point where, on a macro level, so many instruments are kind of in no man's land. So I'm finding it hard to have a positive view or negative view on something, a firm view on many instruments. And if you noticed, my view on equities, with the S&P and the DAX that we cover, it's turned from neutral to bearish. What was it? Just before the summer, or in the summer, when the S&P was 2,850 or something like that. The DAX was above 12,000. I said at the time, 10-year yields were breaking out of a 30-year channel. I said, look, I think this is a trigger for an equity sell-off, and I turned bearish. And we've all seen what's happened. We've had 20% correction, but now 10-year yields in the US are back into the channel. They're back, quite a bit lower. It's like 250 something now, right?
It's crazy. Yeah. So, you've seen yield. This has got to help, this has got to help like the housing market that was a little soft. Here's yields right here at 260. I'm on a 10-year, and then you take a 30-year yields back below 3%. These are big moves that we've seen in yields as they've come off. So that's the rub now for the dollar, is if there's a strong jobs report on Friday, we could have a pretty strong dollar move, as you're right. Everybody's pretty bearish the dollar at the moment. And by the way, I've been kind of monitoring the dollar yen. I want to see how it reacts up here. I have a sell order right now at 108.10. Actually, it's 108.09, but seeing if it gets triggered above these highs. What do you make of the yen moves from the overnight? That was it was algorithmic, happened right after the New York closed, before Asia opened. That was pretty much that was a screw job move. But what do you make of all that?
Well, I think actually there was, obviously, for a move like that, there's no justification. But you can say that the dollar yen in particular, had been lagging equities. We know how correlated dollar yen is with equities, and equities had been going down quite dramatically, and dollar yen was still lagging. It was going down, but it was not following, let's say, in the usual relationship. So maybe there was an element of that in there, that people realizing, this dollar yen, this yen in general is it's too cheap. So dollar yen started catching on, and then we know what happened with, or what probably happened with algos. So I see a rationale for that.
What does the Bank of Japan do from here?
Good question.
Does the Bank of Japan step in? Remember, they were on holiday yesterday, so so tonight when Japan comes back online, what happens? It poses a lot of risk for any yen traders. I don't have any exposure, so I wouldn't mind shorting some dollar yen, but I don't know if I'd be playing the dollar yen going into Asia tonight because of all the Japanese traders coming online with the BOJ possible rhetoric. They could really try to talk down the yen from here.
Yep, they've done this in the past, quite a bit, especially last year. We know that it hadn't been quite, very effective. But, we have to remember that the range of the last, say, 2 or 3 years has been between 100 and 125. So we're still within this range. The Bank of Japan surely will start to get a little bit worried, and will probably try to talk it down. But I don't think we're in a mode at a level where they're going to panic or they're going to do something significant. So you're absolutely right. I think the risk is for the Bank of Japan to say something, like most central bankers do. They, when the currency doesn't go the way they want, they turn to come in and try to jawbone it a little bit. But I think there is a risk. But I think overall, if you look at the last 2 or 3 years, we're still within a range, and I see no need for panic. Let's put it that way.
Okay, well, but obviously the market did panic a little bit last night, and I think if we were to trade back down at 105 on a sustained basis, then you know, that might be maybe some room for worry. As far as the moves that we saw, like if you saw that, I mean, you know, take a look at the Aussie yen. I mean, this is a massive move. I mean,
even the Aussie.
Oh God, the Aussie got killed. I mean, we went from 76 yen below 71, 500 pip move in the Aussie yen overnight. I mean, you know, and obviously we've recovered majority of that, but you know, technically it does some damage. And I know, Coach, you just said Steve doesn't really pay attention to the wicks, but I do. I always have, and it doesn't. You know, if you look at like the Aussie dollar, I mean, you know, these wicks are really important. And I think that move down to the 161% extension was really important, because, you know, as long as everybody's matching the same numbers, and everybody pretty much on every platform is. And so, you know, I think this is a significant low now in the Aussie, but usually whenever I see a wick, unless it's a capitulation move that is during full liquidity type of hours, and you get a capitulation move, I believe where a wick has been, we will revisit. So if it's during periods of illiquidity, I believe that we will come down to the 68-cent level in the Aussie at some point.
You know, Blake, I just want to, you know, push back a little bit, because you were bullish on that Asian session when we put a huge spike in gold for the bottom at 1160, and never revisited that wick. That ended up being the bottom. Do you remember that?
Yeah, and you know, that was, and gold's a different animal, and you, like you said a little bit earlier, you kind of reserve those types of moves for precious metals and things that can be, you know, that can be
thinner,
manipulated. Yeah. Currencies are less likely to be manipulated on a larger scale. You know what I'm saying?
Yeah.
Oh my God. I'll tell you what, this I'm short a pretty big chunk of this New Zealand Canadian. Sorry, I got to take a look at it now.
Okay. You know, while you're doing that, Blake, I think there's almost a larger issue here. You know, people have been talking about market structure and liquidity issues, you know, mainly regarding equities. Okay. And, you know, I think that this is almost a sign that there might be some issues in market structure, because currencies are the deepest market. They're the stock market is smaller than the bond market, global bond markets, and the global bond markets are smaller than the global FX markets. So if this is, you know, a one-off for a year or so, that's different. But if we're going to be susceptible to raids like that, I think it speaks to, you know, what's going on globally throughout the financial markets with liquidity.
It could be. I mean, it really could be. I mean, we're one of the things that scares me a little bit about what we saw last night is this is a, you know, potentially precursor to something that could be a little bit bigger in scope and scale to what's happening with the broader markets. And that's why, you know, if you look at the S&P from a longer term perspective, and you go, well, you know, we've been really rallying for the last 10 years. I mean, you know, we take the lows in the S&P in 2009, right, to where we're at right now. I mean, this is a 10-year rally. And what I'm fearful is that this rally is coming to an end, which doesn't mean that we won't eventually hit all-time highs. I'm actually a believer that stocks only go higher over time. Now it may take 30 years for us to reach 3,000 again. I mean, you know, I may be way past my prime. At that point, I could very well be dead. But I believe that, you know, I believe in. You know, I'd be pretty surprised if I am too alive. But the fact of the matter is that these markets they grind higher. If you believe in human ingenuity and everything else, I believe that we eventually will go higher. But I don't know when we have big gyrations like this and big moves up. You know, we might be in a period, a long-term 10, 20-year consolidation type of period in the markets. I think that's entirely possible. Can you guys hear me right now?
Yes.
We can hear you just fine.
I lost my connection.
I can hear you, Blake.
Okay.
I agree 100% with you, but the reason is called inflation. In my opinion, the main reason for the longer term uptrend, which is going to continue for equities, in my opinion, the main reason is inflation.
I agree with that. I think it's both, human ingenuity and technological advance and all that, plus inflation. Look at the value of $1 million 10 years ago or 20 years ago. Look at the value now. It's just going to keep going.
They're both valuable to me. They were then, and it was then, and it would still be now, buddy.
So after having such a strong number in the in ADP, I mean, you can see the dollar yen's pulling back a little bit. The euro dollar continues to bounce here, and we've kind of shrugged off those stronger numbers. But I think the real number that we'll be looking at is going to be tomorrow's non-farm payroll. And for some reason, my JP Morgan platform went down, which I'm a little upset about right now. And I'm not sure why it would. And JP Morgan doesn't go down, which is odd. Hold on really quick. Let me try something else.
I think Greg is going to join us too, Blake, today.
No.
Oh, he's not?
Tomorrow. Coach,
Okay.
He said tomorrow, yes.
Okay.
Yeah, so he's going to be coming in tomorrow. So anyway, now let's real quick. Let's take a look at some of these currencies here. And I know Steve is his voice is gone right now. So, like if you take a look at the pound. Okay, so this is one of those moves that unfortunately, if you were long the cable and you had stops, below that. Damn it. Let me see here. Let me put. You can see right here, stops below the 125 level and below the trend lows. I mean, you got triggered, you got tripped last night, and especially if you're a European trader, you got up in the morning, you're like, what the hell happened to my account? A lot of these moves, I mean, they tripped your stops, no matter how wide they were. Overnight. I mean, look at the Aussie, same type of situation. But I'm like, for example, I'm looking at the Aussie. If you ignore, some of the wicks just from a price action standpoint. Look, any move in the Aussie back up to 70 cents. I mean, this is going to be, people are going to be looking at this as a, pretty strong sell zone. I mean, I know I am. Like, I look at the Aussie now, it's like, okay, get above 70 cents and let's see what we can do with it. Hold on. I got to restart my JP Morgan. Hey, Stelios, are you here? Or Coach?
Yeah, I am here. Actually,
don't worry, I'm here as well, and I can cover for.
I'm going to flip it over to you for just a second. Give me 1 second so I can restart my my JP Morgan.
Actually, while you do that, there's a comment by one of our friends, and I want to see if I'm reading it correctly. It says algos the same bullshit as news, just to blame moves. So I read that in terms of, we see a market move and we explain it by saying
no. But it's not I wholeheartly disagree. I think algorithms are a severe problem in the markets now, and because but anyway, they're automated and they will push the market with a lot of liquidity. Especially when the markets, when the markets are illiquid, they will push with their own liquidity. So,
yeah, I was just going to actually, I was just going to say that I agree 100% with that, Blake. And I personally saw that when I was trading 10 years ago, sterling rates, and I was trading short sterling futures, which is the 3-month futures for sterling rates. When the algos came in, the first algo, I think it was Polish or something like that, I can't remember. There were, 1,000, 2,000 contracts on either side of each instrument. And then suddenly you could see when they came in, they would put in like 5,000, 10,000. They would move things so badly. And it made a huge difference from one year to the next. So algos are real and they do affect a lot of things. I mean, they really do.
First of all, no human would ever push. For example, yesterday we had a move in Aussie yen. that within a few seconds, like it depreciated by 7%. 7%. No human would sell under such conditions any decent quantity of a currency. It makes no sense. You lose money, right? I
Yeah.
mean, you know.
First algo I saw, guys, was the robot in Lost in Space, where Dr. Smith and Will Robinson had their own robot. So anyway, that was more than 10 years ago. If you guys remember it, you're an old man like me. All right. So, Steve, your voice, I really want you to save it because no one does a better review of the board. And, you know, if you want to talk, go ahead. But, you know, we can fill in.
If Blake is back, I'm just going to show this.
Okay.
We also posted it on, you know, the CMT's smart brief. Yesterday's pullback gave an excellent opportunity. We made a pattern in play yesterday on the breakout of this inverted head and shoulders formation in crude. I think this is a very nice pattern which points to 15.5. And I do think that we can easily even surpass that. So I do think that this was a very nice trading setup that we got here. Now
you've been long for a while. You've been long. I remember you talking about scaling into it, and maybe you took a piece off.
My cost average is at 44, and yesterday, yes, I did book part of my position for 6.7% profit, something like that. So so I have no risk at all on the table anymore, but I still think that yesterday's pullback gave an excellent opportunity for people that weren't participating in this market to actually participate. And those in ForexAnalytix know it because they got a pattern in play immediately once we were breaking out of this formation. So, you know,
people got it for free, and the chart of the day keeps the confusion away. That's a free blog post that Blake does every day.
Well, it wasn't me yesterday. It was actually Steve.
Okay. Yesterday it was me. Yeah.
All right.
But usually, yeah.
Yeah, so great job, Steve. And here, let me go. I had to restart my JP Morgan. I don't know why I went down, but it's all working now. So so anyway, Steve, great call on crude, and I think I'll be really happy if crude continues to rally, actually, because you know, we get this inverted head and shoulder pattern. We get up to like $52. That means that New Zealand Canadian's probably about 100 pips lower. So I'm happy about that. All right. So yeah, speaking of the Canadian, so the Canadian is actually breaking through the support. This is pretty key support in this big up channel. Now, tomorrow we have the Canadian jobs report, not just the U.S. jobs report. So the Canadian jobs report, you know, and the thing that I could wish most for in my situation, not saying everybody's situation, but for me particularly, is if we get a strong Canadian jobs report and a weaker U.S. jobs report. Now, the whisper number for non-farm payroll has got to be a little bit higher going after that ADP. I would say it's probably in the 190, 195 range. And we'll probably start hearing those. Well, at least my office will start getting some of those probably this afternoon. But yeah, I'm assuming the whisper number is going to be a little bit higher. But you know, we'll see what those numbers come in as. But as far as the Canadian goes, we had and by the way, if you were trading intraday, if you were in the ForexAnalytix chat room, we had a bear flag setting up. And we broke down and we completed the bear flag, but obviously continued to break down following the number. So it gave us a little bit more than, well, a lot more than I thought was going to happen. U.S. dollar, Mexican peso. Sorry, I haven't dealt with that much. It's not really doing a whole lot. Let's go over. I'm going to take us back over to the daily chart. Swissy, I'm kind of leaving alone right now. One of the strong moves that we saw overnight was the Swedish krona, and the Swedish krona has bounced pretty aggressively. Now, Stelios, I know you follow the numbers out of Sweden. So was it some inflation numbers that pushed the U.S. dollar Swedish krona higher?
You're talking about yesterday or today?
Was it last night or was it today that did it?
Number of wise, the only thing we saw was manufacturing PMI coming in weaker than expected. Today, I don't think we had anything.
Oh, we didn't. Okay.
No, as far as I know, no.
Let me see here. I
missed it. I don't know. I did drink a lot over New Year's, so maybe I missed some stuff.
Maybe you're trying to catch up here. Let me take a real quick look here, because I thought there was some household lending growth. I don't think that would be the number that would be a mover. But anyway, the U.S. dollar Swedish krona spiked up pretty aggressively, and I haven't touched the Norwegian krona or the Swedish krona since I was shorting the U.S. dollar Norwegian krona right here. And as you can see, after my chart formations kind of disappeared, I really haven't been trading it a whole lot. Even on the next leg higher that we've had in the U.S. dollar Norwegian krona, but it's been pretty resilient. But I'll tell you guys, if crude oil starts to rally from here, let me get rid of this really quick. So what we could have here is not that. I want where's my curve? They change this up every once in a while, so then I lose my drawing tools on how I'm not that. Where is it's here, right here. Okay. So this has a little bit of a head and shoulder pattern look to it, developing here with the US dollar Norwegian krona. So this is one of those pairs you kind of pay attention to, especially if you're looking at correlations, and this I think has a pretty good setup here for possible short. There's your neckline in the head and shoulder pattern. So this is a play if we have weak numbers tomorrow and crude oil continues to rally. Then you have a U.S. dollar Norwegian krona that's a good setup for a possible short. Nice little head and shoulder pattern there. Now, as far as the dollar yen goes, after last night's moves, as I told you, I have an order to sell at 108.09. So, and it didn't get there, and I might actually just cancel my order. I was hoping what we would do is spike above these highs here, spike above these highs, and give us that move above 108. It just didn't happen. Now I don't know what to do with it at this point. I think if equities do roll over, then the risk is that you can break back below, this 107, 40, 50 level. And then we could see some selling come back in and take us back below 107. But if the story with the exporters, as far as losing their hedges, their hedges being knocked out at 105 last night, the risk is that they have to sell dollar yen, higher, or try to sell it as high as possible to put on some hedges against long, short yen exposure that many exporters keep as a hedge for their businesses. So, and when I'm talking exporters, I'm talking about big corporations worldwide. So, if that's the case, then the dollar yen should not really be able to rally a whole lot. But what I would probably be doing, today, and just talking about today and what we can navigate through today, is I'd be trading the ranges. So you probably want to look at 108 being upper end of the range, 106 and change being the lower end of the range, and trying to trade it in between here. Like for me, I'm a seller. Let me grab my pen. I'm a seller up here. I'm a buyer down here. We get below 107, I'll be buying. If we get above 108, I'll be selling. And this is going into tomorrow's non-farm payroll. I'm looking for extremes now today to navigate around, because I don't think there's a lot of risk in playing the range for today. As long as you're playing the extremes of the range and you can keep your stops tight, that I think is the easier play today. The question is, do we even revisit 108 again? I mean, if the dollar yen can't rally on a strong ADP number, if we get a strong ISM, maybe that might be the catalyst that puts us above 108, because if we get a strong ADP, a strong ISM, remember we're looking at the ISM manufacturing numbers. We won't get the services numbers until tomorrow after the number, I believe. Oh, maybe we'll get it on Tuesday because of the holiday next week. But regardless, we'd have to have a strong we'd have to have a strong ISM, with the strong ADP to get us back above 108. And because of the price action from last night, I still expect sellers to come in, and I expect, whether it is exporters or whatever, because, Japan's markets may be open tonight, but I can guarantee you right now that they're doing business at this moment, and they're actively in the markets trying to put on their dollar yen shorts and trying to rehedge their positions. So that probably is what causes the selling above the 108 level. So that's what I'm hoping is going to happen. I hope we get a strong ISM number and I can sell into some strength here and just play it back into the range going into tomorrow's non-farm payroll. Tomorrow's non-farm payroll will be tricky because, and I was going to say a little bit earlier before the ADP number, is I'm not sure how to actually trade a weak number. If we get a weak number tomorrow, a strong number is pretty easy. I think a strong number, we can play the dollar yen, we can play it, spike up, back up to 109 going into tomorrow's number. We could probably play the euro back down to 113 as we're still in this big, here, if you go to the euro, we're still in this big 113, 115 range. Here's the 4-hour chart. So, I mean, on a strong NFP, I think that's the right play. If we have a weak NFP, I'm not really too sure what to do, because I don't think that a weak non-farm payroll is going to take us from current levels beyond 115. I may be wrong here, but it could take us back up to 115. But I think with a weak number, you're going to see risk off coming into the markets, which is just going to weigh on the euro yen. And that's going to keep a lid on the euro dollar on any significant rally. That's why I'm having a more difficult time with that. And I kind of don't want to sell the dollar yen at current levels unless we were trading above 108. Then I'd be more interested. But we'll have to revisit all that going into tomorrow's numbers. A couple of last things that we should probably take a look at, and then, Coach, are you there? Maybe Stelios is here. Okay.
I am.
We can see if there's any questions that pop up. So gold. This is one of those really interesting moves. I saw when we hit 618 yesterday, we stalled. Daily RSI is really overbought. We're still struggling here at the 618. You can see how we pushed above it, and we're pushing right into previous, this is all that previous support zone right here. So same level. It's I think, and I'm not trading gold right now, but I think honestly you can just sell gold here and try to play it intraday. I don't think you're risking a whole lot. However, this is one of those things that I'm looking at going into tomorrow, because if we have weak data tomorrow and gold continues to power higher above 1300, that if I for example tomorrow, if I decided, weak data, I buy the euro, and the euro, let's say I buy the euro and it's trading at 113.80, 114. The only thing that's really going to keep me in the euro dollar and keep me long the euro dollar is a move higher in gold. So, I'd have to see gold continuing to break out. My biggest fear, though, is that gold's, overbought on a day, and we're struggling here at this resistance. The better trade is if the number is weak, okay, or excuse me, if the number is strong, okay, the number is strong and the euro starts to break down, the gold trade might be a really good short going into tomorrow. if we have a strong piece of data. I think for those of you that trade precious metals, gold's had a nice run. I mean, we've gone, just 1240 to 1290, over the course of the last 2 weeks. It's a $50 rise in gold. It could be due for a 20-point pullback following a weak number, or excuse me, a strong number tomorrow. We got a strong number, and the euro dollar falls back towards 113, 112.80. Gold could be a nice short. So I think that's a decent setup. Silver's having a little bit of a rejection here at the 50% retracement, but we are above the 200-day in silver, and well above the 200-day in gold. Yeah.
Some of the people that I follow and have interviewed that were, just calling this a bear market rally in the precious metals, and they allowed for the numbers we got to, like, 1287, 1560 to 70 silver, which I want to ask Greg about it, because he kind of felt the same way, are saying that the way the metals went up is changing their longer term macro view, that we're not going to get that, break back down, under 1390 in silver and 1160 in gold, that it's trading in a series, and Steve would know about this, 1-2-1-2. So any break, especially like the 1250 gold, should be bought because of structure. And, you have to learn how to change your mind. So some Ellioticians that were calling this a bear market rally are starting to say that the way it went up is showing different behavior than a bear market rally. Just wanted to put it out there.
Yeah, I personally, I think gold is still longer term. I think gold is in a situation where we can see above 1400 at some point.
Yeah. They're talking 1600 for this advance. It's could be a pretty big wave, and they were talking about one more flush. I think Steve thought so too. Maybe his mind has changed. So a WD Gann, right? If you don't learn how to change your mind, you won't have any change left.
Not yet though, coach.
Not yet, Steve.
I haven't changed my mind yet. No.
Okay.
I need to see more evidence that something more impulsive is unfolding here. Has gold rebounded more than I expected? Yes. But do I see clear signs that we found a bottom? No. So my expectation would still be that there is a decent chance for one more flush lower.
Okay.
Yeah, and maybe the flush is not something so big, but maybe something back down to 1230, something like this.
As always, time will tell.
Yeah, and but I'll tell you, in the current market environment, I wouldn't want to be short gold. Not like any extended period of time, other than trading for in and out for a couple of days. I mean, most of the things that talk about are trading in and out for a couple of days. But if you're, longer term, I don't think I'd want to be short gold. Not down here.
But I guess you agree, Blake, that you wouldn't be buying it right now, right here.
No. I'd have a very tough time buying things when they're sitting at a golden fib at the 618.
Exactly.
So, but like I said, a move down to 1240 would probably offer a really nice buying opportunity. If you got a move like this, back down to 1240, that would be an awesome place to be on the long side, I would think.
I don't pay a lot of attention to COTs, but part of the reason for this move that people were looking for was historic short positions in the COT and the gold, near the bottom. I don't know if that shifted during this, $120 rally.
It has shifted, but historically speaking, we're still quite short. I mean, we were in the situation that we actually had, short positions, which is a very rare occurrence. We don't have it anymore, but still, historically speaking, the market is definitely not long, if that's what you're asking me.
That's what's so great about hanging around with you guys. Really, you saved me so much time of having to go look things up myself.
Yeah. So
Thank you.
if we,
As you can see, the spec market has really come off of being really short. So,
Yeah.
yes,
so
but there is space. There is space. I mean, that's not
I
a
mean,
problem
this
yeah.
could go this could go net long. I mean, we
Yeah.
could, you know, we could go net long, and that could put gold, you know, that could put gold at 1400 or 1380 pretty
But
easily. I mean,
Blake,
so
if you go down to a 4-hour chart, you'll notice on gold, you'll notice that there is a good chance that what gold is doing here. First of all, you'll notice that there is RSI divergence beginning
Yeah.
in 4th of February. Sorry, of December. So we have RSI divergence going on for a month, for a whole month. And second of all, you'll see on the 4-hour chart that you can actually draw this as an ascending wedge, and it aligns quite perfectly.
yeah,
I mean,
and I see what you're talking about. I mean, we could have something that looks like this,
exactly
that allows us a
exactly
little bit of a
Yeah.
correction.
I would
exactly.
take it back to the base of the wedge, 1240, the breakout.
Yeah. Yeah, I mean, maybe something like that.
Yeah.
I whenever I see a wedge, I always look for 50%, maybe 618, retracement.
Okay.
That. But
Yeah, and look at that RSI divergence. I mean,
Yeah.
it's one whole month that's been going on the 4-hour.
Well,
Yeah.
I have it, guys, on I think it's a 1-hour chart. The 50 MA held it at today's low, and under today's low, I think it gets vulnerable. So I think we were down to 1282 or 3 before this recent pop, and so there it is. The wedge lines were right where the moving average is on the 1-hour. So yeah, do or die here.
Yeah, it is. So Dale, I know you have a interview coming up, but
Yeah.
we had a question, Steve. Do you still look at palladium at all?
Sure, of course.
Do you want to take a real quick look at palladium for?
Absolutely, and I will also have a
December?
look at Indian rupee because we had another friend asking for it.
Okay, I don't know. Here you are. Let's grab you, and I'll flip you over to the charts really quick. And and guys, I'm gonna go ahead and log off. I'm gonna get to the market. So, you guys have a great session today. Have a great interview, Coach, and I'll see you guys tomorrow for NFP. Okay.
Great webinar today, Blake. Thank you.
Thanks, guys.
See you, Blake.
See you guys. See you still, Steve.
Bye, mate.
Before you start, Steve, John Davies, are you in the house? If so, I've typed your name in. I don't see you. Maybe ask a question. Okay.
Yeah, he just answered.
Okay, great. Okay, go ahead, Steve.
Yeah. So 3 things very fast. 1, palladium. Palladium still showing clear signs of RSI divergence, and at the same time, we have very clear signs of momentum loss. On the other hand, despite having all that, it hasn't managed to break down. So, there are 2 possibilities. When we were down here, I said that we're going to move once more higher towards the 161.8. We did move higher. We didn't tag the 161.8. So 2 chances from here. 1, push higher once again towards the 161.8. The second one is go down to 1224, break below it, in which case we at least have a rectangle formation here, which is going to open up a decent amount of downside. So I would be interested to look for short opportunities in palladium, either in the case that we push towards 1330, or definitely if we get rejected, if we keep getting rejected from this area at 1267, 1270, and we finally break down from 1224, I think there is going to be continuation. I think that should lead to at least a retest of 1140. So that covers one of the questions. Then we have another question about the USD against the Indian rupee. We've seen a decent move lower, but I would be very careful here because, as I had said in the past, this 68, 70, 69 area is a very strong support area. Also very clean and clear RSI divergence on the daily. So I would be quite careful here. I don't think, this is a good area to be shorting because there is no risk reward to be doing that. And one last thing, we had a question about the DAX, and then you can go ahead with your interview, coach. The DAX remains clearly under pressure. I remind you that we have a head and shoulders formation that anyhow pointed lower. The inability of the DAX to push through any of the resistance levels at any of the rebounds it has produced, forces me to keep looking lower towards the 10,000 area. So, unless we break back above 11,000, I think the path of least resistance remains to the downside. So, having said that, thank you very much and enjoy the interview.
No raising your voice to Jason today. Promise? Huh?
In general.
I know you don't. Just
in general, yeah, I try to parent him without having to raise him. Yeah.
I'm sure you do. All right, buddy. I hope you feel better. And John,
actually,
Davies,
I do feel better. Just the voice hasn't come back yet.
Okay, bro. All right. Thank you, Steve, so much for you're a trooper, and thank you, Stel, for backing everyone up today as always. You're one of my favorite guys on the team, and John Davies.
Pleasure, coach.
Really looking forward to meeting you and speaking with you. I've now made you the presenter so we could hear you. And if you have anything you want to show, there's a screen share option, and we could talk a little bit about your journey and what you think of current market structure, especially with what happened yesterday with all these raids in the FX market. So,
well, I think right now you have to, and I suppose you might, if you read anything to what I believe in, I'm very much a long-term investor.
Okay, John. So, are you? You're a little soft.
Can you hear me?
But do you want to show your setup? There is a screen share option, or no? It's optional.
No, it actually doesn't look like it's possible. I'm trying to show it, and it looks like it keeps flipping. So I'm not positive, but
yeah, it's just a drop down where it says share screen, and then you choose which screen.
I'm trying to do it right now, and it's not really having much luck presenting. No, can you hear me better now?
I can hear you better now. Yes.
What I was saying is, I'm more of a long game investor who looks at distressed situations. Now, when I say long game, I'm looking at a long game presentation, a long game investment strategy, predominantly and I have been for many years, predominantly commodities based. But when I say long game, I have to go through the short term with that. And with that strategy, and with my strategies I've talked about, is risk management comes first. And within my goals, I might take a slightly different different approach than others. My goal is to significantly reduce the cost of my equity investments through option positions. So I'm looking at situations that I believe in very strongly. I mean, I happened to step onto your show yesterday when we were talking about copper, which is obviously the bellwether, and everyone wants to really, as we were showing concerns over copper, which is only natural. We're looking at
there it is, John.
We're looking at a potential, whether or not we've got that. Whether we're testing that support of early September, and whether or not we've got a breakdown from 264 down to the 240 ranges. Now, in those situations, my belief is in long term, and I guess there's some pretty valued investors, pretty important investors who share the same thing of looking at Freeport, FCX. Within my goals, I look at a strategy with options that radically reduces the investment of that within my goal is within 30 months to pay down the entire cost of the investment, assuming a person has a long equity position. So what you then looking at.
How do you do that? You write calls to
you're going to look at a few different situations, and let's take a look at
there's Freeport. I put it up for you if you want to talk.
Yeah, okay. So there's a beautiful situation Freeport, right? You're looking at a company trading at a tremendously low price in comparative historical, right? And whether or not a person, I would look at legging in. And I don't know if the gentleman, if you had mentioned this yesterday, I think someone did on incremental buying positions. And I look at legging in a market like this. I like to leg in either 1/3 or 1/4 positions. So I will be looking at, and it depends on the premium, of garnering a premium of any situation of upwards of 1.5% a week within a covered call position. So you're going to look at the weeklies, and that breaks you down to a lot of different things, different equities. But Freeport is obviously the best example of copper. And then you're going to be rolling into a position where you have a cascading series of puts. You're writing a cascading series of puts. Now, that allows you a lower accumulation. And with someone like Freeport, or whether or not you're looking at you're mentioning gold, if you're looking at precious metals, if you're looking at Barrick, the new Barrick Rheingold, or you're looking at in silver, let's say First Majestic or Fortuna, it allows you to say, okay, I'm defining my investment cost at this time. Maybe it'd be 10,000, maybe it'd be 50,000, whatever it might be, and I'm dividing into incremental positions. And within that, I'm gradually and systematically reducing the cost. Now, the goal has to be that you want to drive in approximately 1.5% per week of the original book cost. And in so doing, and at that time, any of the extra premium up to 1/2 of that, you're adding for additional portfolio insurance, maybe a long put position. But at the similar time, as if you're doing that, you might be putting in a put, putting in a bear put spread, where you might also be writing puts in the event that it's going to drop. So we're looking at a very systematic approach to portfolio acquisition. Now, I know that seems that might be a little bit odd in today's market, from what I read at least.
Well, I just think it might be a little complicated for
You think so?
viewers to know. Well, just to know when to put these on, and how you manage risk when you're writing options. And that may be from both writing puts and calls. Does that help you with risk management?
It certainly does. Well, when you're writing a put, that's a different thing. And of course, that is the only difference when writing a put is you're defining where you're going to accumulate the price, accumulate the equity. Like, for instance, I just mentioned today on Twitter, and I know a lot of people are going to be going out and bottom fishing, are thinking of bottom fishing Apple today. And I know that's going to be the big celebrity today of bottom fishing. And I hope that they think of, okay, so if I'm going to do that, where am I going to look to acquire? Am I going to be looking at acquiring at 145? Well, sure, if you like it at 145, will you like it at 120? So maybe you're
you select a strike price and write the put, precisely. And then if it goes to that level, you're prepared to buy it at that lower cost.
And the overwhelming majority of these are never going to happen. When you're writing, I mean, look at if we jump back to Freeport, we're looking at a 1036 closing. How would a person like to be looking at? We're going out a little bit farther. We're looking at maybe the 950. We should, we're obviously going to get a little bit of weakness today. But if you start looking at those 950s, as far as writing, there's no reason a person can't come in and say, you know what, I'm going to go out there and I like the situation. I've looked at the fundamentals, right? I'm one of those old boring guys who likes fundamentals. Maybe you've done your analysis. You've looked at the enterprise value. You want to target those enterprise values that are really, really strong, like that under 7. And then you say, well, what I'm going to do is I'm going to go out and aggressively, I'm not going to go out there and say, write a deep or a far out of the money call. I'm going to write it at the money call, or even in some situations, if the premium is sufficient, then in the money call, you just scalp there. Once you look at your commission, if it's sufficient, you say, what I really want is 1.5% a week. Now, 1.5% a week really adds up. But, like something like Freeport, if you're going in, and let's say you're going in a 1/3 incremental position, maybe you're going to look at the near term. Okay, I'd like it at approximately 1050, but I'm only going to take 1/3, and I'm going to, just come in under the 1050 mark. I'm at 1036. I'm going to write the 1050 calls, but maybe I'm going to look at writing those 950 puts on little, those 950 puts, right? And maybe I'll look at and now what I've done is at that situation, 1/3, I've immediately reduced the cost a little more. You're using that premium to pay for it, and you're bringing it down. And that's why a cascading series of puts. And cascading means that you have to look at it like a pyramid, so that if you're buying 1 unit at 10, do you buy 1.5 units at 9? Do you buy 2 units at 8? And you bring down, you look at aggressively bring down, but you know how much is going in, how much you got going into this investment, and that you want to, right? Does that make sense?
Well, let me ask you this, John. There's probably some people who thought when we went to 12, halfway back of the whole move, that might have been the time. So how did you discern the 10, which is an interesting area? 1036 is actually 61.8 back of the whole move.
Yeah, no, it is. It's very interesting. It's a very interesting area, and it's also coming.
So how does a fundamentalist discern without technicals discern a price level?
You're going to have to. Yeah, that's a good question, because you're going to have to go back and forth and say, no fundamental investor can come to the party without understanding technicals, right?
Okay, all right.
And you absolutely, you can't just be a pure fundamental investor and say you're going to ignore technicals. And I'll give you the good example of that.
Jack Schwager says that, John. I interviewed him, and we had this discussion of fundamentals and technicals, and what he said is he prefers technical traders because fundamentalists, when they're wrong and the price gets cheaper, say they're accumulating, they still believe they're right and they're getting it at an even better price, and it turns into a blow up.
You don't double down. You don't double down on your losers, right?
Yeah.
You never double down.
Well, I have.
Yeah, well, that's one of the that's one of those problems that we all. But see, for me, my goal, like I rarely enter a position. I mean, rarely enter a position. It will be no more than a portion of my portfolio resigned to juniors, where I'm not looking at hedging via options. If I'm not hedging with options, I don't want it. I simply won't. Okay. Like, you have to come early to the party, and I'll give you a good example of that is Cameco. Now, I'm bullish on uranium, but I'm getting a little bit squeamish because a lot more people are now bullish on it. So it's getting to be
it's getting a lot of hype on Twitter.
It's getting way too much hype, and I don't like it. But I entered Cameco when it was quite low. I entered Cameco in actually the end of October.
What's the symbol, John?
CCJ, and that's the uranium powerhouse. I entered Cameco at the end of October last year, and it had just taken a nice run up through the past year, and it was approximately $8. It was approximately $8, and the goal was, I believe, this is going to happen. This is going to go back to its old heydays, and we're going to see this situation move back into, certainly see those lofty periods where it's back into potentially that $25, $30 range. But that's going to take some time, right? That's going to take some time. But in so doing, during that time, I want to write off that cost of investment. Now, at that moment, the options on it were offering tremendous premiums. So what I did basically was, you have to come early to the party. Now, what you got is Cameco. It's bounced. It's seen $12 in the last year, and it's back down to just under 11.5. But when you come in there early, you come in there at $8. Come in there early at $8. You start looking at writing those options. And if you can come out, if you can go out a month and you can get 3.5% on that, you're going to gradually reduce your investment. And the goal is, and all you have to do is look at this as a mathematic thing, is you want to eliminate the cost of investment through the writing of calls and paying for part of the investment through writing of puts at a much lower price. Remember, You know, in that situation, I think I did. If you like, for instance, Freeport today at 10.36, you're probably going to like it at $9 and $9.50. So you look at incrementing part of the trade in that situation. So what you'll do is you look to write calls and then say, okay, that's only 1/3 of my position. The other 2/3 of my position, I'm going to cascade down. And if those puts, if the stock, as you certainly wish and you believe, is going to stay up and ascend, you're going to be paying down the cost of your existing position. Now, that's going to mean that you're going to take time to get your accumulated, your target, right? Your target shares, but so be it. You basically reduce the cost of investment. Now, with Cameco, because of that strategy and the way it moved up, I've been able to consistently eliminate my cost of investment for everything in Cameco in roughly 6 to 8 months per section, right, of the portfolio. And that's what I do.
So you own it for free?
You own it for free. And by the way, when do you, and well, now this is one thing, and I speak almost, it seems like I'm in New York right now, and when I was in Toronto last summer and in London, this is one of the things that I speak to investors all the time, particularly investors who have a dividend section of their portfolio. And I say, well, let's look at this thing. If we are doing this with dividends section, pick whatever you'd like, right? Let's not pick GE, but something that you feel good about on it. What's your yield? What's your yield on your investment when it's for free? And
yeah,
so
interesting.
It's exactly.
It's unlimited.
Now, that's exactly. Now, when you look at, that's exactly it. I mean, it's just infinite and it just keeps growing. You do that with every situation. So, I resign 90% of my portfolio to situations that I can hedge and accumulate and radically, I say accelerate the reduction. Now, accelerate the reduction of paying down the cost of investment. And this is something that you're, every person listening to, because, obviously on your show, I've heard a lot of people talking about gold, right? And I think probably one of the most general, correct me if I'm wrong, it seems like we all have the same opinion, or we certainly do. Gold looks tremendous. It's moved well. But boy, that straight up line is kind of uncomfortable, right? Of the last little while. It looks ready for a general easing before another further pop. That's if you're a gold bug, you believe in a pop, right? And certainly we could see that test back down to 1260, and I think we'd all be salivating if we got it back into 1240. Now, if, say, for instance, you believed in equities in that sector, right? You pick out whichever you like, but let's just go with Barrick or Goldcorp. And you'd say, okay, so I want to have exposure to this. Well, if you're thinking of that sector, why don't you define your risk? And then immediately, and you have to work these numbers out on yourself, define your risk, look at what is the profit center or the profit margin that you want. Now, when I pay off an investment in 30 months, you just do the math on that real quick. What you're seeing is, my gosh, you're getting well over 36%. And when you can compound this over year after year, it's a heck of an ROI, right?
Who let the dogs out?
That's exactly it. Well, he's
I've had dogs as trading partners through a lot of my career, and when they're laying on their back, they're bearish. On their stomach, they're bullish. So
there you go. Well, he's having some fun right now. He's announcing.
Anyway, he wants you to write some more puts on milk bones.
There you go. I'll have the dog, the milk bone puts. But yeah, it's kind of a funny situation right now. What you can do is that, I think investors right now, and again, I've been doing this for 35 years. I think investors right now are so short-term minded that they forget the long term, the long game. And the long game is where you take these investments. You have a great investment of participation in the economy. They help build the economy. They provide you this extraordinary revenue. But when you use options to radically reduce your risk and then basically pay down the profit, you really doubled your ROI in a short period of time, relatively short period of time, without this equity really moving a tangible amount. Anything extreme if you use options, but you also, what makes a priority of risk management, is this is possible, and maybe this is just the changing of the investment public's approach, tactics of the modern investor. But when you look at using options and you look at scalping, because what I tell people is I don't believe any person can predict a market movement. Everyone thinks they can, or they just can't predict it. Is that every week a market will go up, a market will go down. Some people can predict it perfectly, but every week an option premium decays.
Right.
And
Options, John, options are like relationships. 90% of them expire worthless. But but anyway, those 10% are worth pursuing.
No, they're absolutely
in relationships. In relationships.
Yeah, you know what? Anyway. It's absolutely true. But here's the thing: is that when investors look at this approach, they can become involved in the bluest of blue chips, whatever it might be, and then they can get involved and radically reduce the cost of anything that they do without significant risk exposure where they otherwise might have. And that's something that I really like to see investors take part in. I think this is also an important thing for us to consider of future generations of investors. I don't know if you're familiar, but we really have a problem with
millennials.
The millennial generation investing. And
they're only paying attention to crypto.
Well, they're barely that. And
hold on, John. I have to put my yellow hard hat on. Go ahead. Now it's on.
It's echoing up. I'm sorry.
All right.
It's one of those things that's happening, and it's a real problem for us. I mean, it goes into that fourth turning philosophy. Is that we've got a whole group of investors who are no longer taking part, and I hate to see what happens. Well, we all start to retire, right? And when we retire, when we start looking at pension funds and winemakers, we've just got a group of people that are, no longer in the marketplace.
Yeah, that's the Harry Dent demographic bearish argument about baby boomers retiring, who's going to come in, and they'll be selling stocks.
Well, that was written up. Yeah, that was written up years ago. You know, the gentleman who wrote The Fourth Generation. Now, I think what that is going to create is it's honestly just going to create market opportunities for fundamentalists. But what I'd like to see is a whole generation. This is one of the things that I'm dedicating much of balance in my career to, is getting a whole generation of investors not being scared off by the market, but realizing how simple gains can be. I'll give you a great example. A funny story was around 2 years ago, I bought a new house. And when I bought the house, and I think the financing, the mortgage rates were 2.3% approximately, right? And I asked my banker, and I said, "Well, I'd like a mortgage on this." They said, "Mr. Davies, why are you asking for a mortgage on this?" It's and I said, "Because I'm taking the mortgage in for 2.3%. I'm buying your bank stock, which has a yield of 6.5. I'm writing covered calls on it and buying puts. I'm going to really triple my money on the money you're giving me on your stock." And that's how I'd just like to see investors come in there, because we've got some, right now people will talk a great deal about how the markets are overvalued in certain sectors. But let me tell you, the mining sector is not overvalued. Oh, yes. So the mining sector is beaten down. And the mining sector, I hate to tell people, you're not going to be worried about their mobile phones and technology if you don't have enough copper or cobalt coming out of the ground, because everything will go up exponentially. So the mining sector is trading at ridiculous discounts. I mean, I can't believe that we're even worried about Freeport. I mean, Freeport here at 1036, or many others are trading at a fraction of their enterprise value. Just go out there, acquire them, take a long-term approach, write those cover calls, define your risk, come in with, obviously, this is just cash positions, no margin. Come in there, define your positions, take that revenue, and you're probably, in most situations, you're going to be generating, roughly speaking, 15 to 20% of an ROI if the equity just stays flat, relatively speaking. But you're going to radically reduce your cost. Then if you come in there and you're right out of the money puts, and you look to accumulate on any weakness, it's going to be gold for you.
Okay, John. So excellent presentation of your investment model. How about telling us about your business model? I see that you do training. Do you write a letter?
I don't write any present newsletter. I'm going to start a program online webinar just to teach investors, just the everyday mom and dad, how to use options to reduce risk, to help their, many situations will be the retirement age. I love being able to help people with their dividend funds so they have lower risk, if not risk eliminated, and increase the revenue coming home. I'm going to start a whole program webinar. It's going to be free of charge, just online to help what I believe, the investment industry and investors worldwide.
Okay, that's a good idea to offer it free, especially millennials can't afford these numbers that I see here. Well, so and if you want them to invest, first they have to, they're saddled with their student loan debt, so this would be, unattainable for them. So kudos.
And I think it's just something that we have to do. I mean, the investment industry has given me a great career, and I'd like to see an entire generation learn of how that they can invest in safe, long-term assets and build a legacy and accumulate wealth and preserve it. Right.
Right. So I really appreciate you coming in today, John. Great to meet you. You're a trading warrior brother of mine, even though you're more of an investor option writer. And people can follow you on Twitter at Renegade Style. So you consider what you talked about today as, I would consider it a fairly aggressive, conservative approach rather than speccing with a lot of leverage. Why did you choose Renegade?
Oh, well, all my approach, this goes back 30 years ago, and everything I've done is believing in understanding numbers, math. And I always make a joke. It's just a math geek life. I'm just I had a great discussion with a guy who's an expert in lithium. We were sitting at a cafe.
I used to have to take that when I was trading big on the floor.
And I used to, lithium. And I was talking to him, and I said, there you go. And I said, I'm basically a slide rule quant. And the kid, he's a young guy looking, he said, no, back before we're using, those TIs, I was, a slide rule quant doing all my analysis with a slide rule and paper graphs. And I still use a large chalkboard in doing calendar spreads. But, it all comes down to understanding numbers and the prediction of numbers, prediction of commodity prices. And somewhere in around 1983, when I was first studying options, I realized I can try to predict these things all I want, just like anyone else. But no matter what, it's not going to be perfect. But what is going to be perfect is each week, these options will expire with zero premium. In other words, things can go up and go down, but you can actually make money on little movement. And so I looked at that and I said, this is really just another version of time arbitrages, and you might as well scalp it out.
Yeah, isn't it amazing how market makers can pin a price into expiration where there's the most open interest?
It's fascinating, isn't it?
See, you didn't think I knew things like that. Anyway, John, great meeting you. I wish you a successful, prosperous, healthy, joyful 2019 for you and your family and all your mentees that you teach. And
well, thank you very much, Dale. Really, it really was a pleasure. I hate to put it this way, but I just started listening to your show because yesterday I was so excited to be on. I came on early, but I love your show and I really look forward to attending and watching it, listening more.
You're always welcome, John, and you may even want to consider becoming a subscriber like many of my other guests have become.
I think I'm going to.
I mean,
Thank you
great
very much.
input from the team. This is a team we have here at ForexAnalytix, and I'm happy just to be a spoke in the wheel. So
that's exactly it, isn't it, Dale?
yeah. So thank you, John. You're now my trading warrior brother, like it or not. And good luck and good hunting. And let's keep in touch.
Thank you very much, Dale. Have a wonderful day, and thank you for having me on the show. And I wish your subscribers all the very best and a happy new year.
Thank you so much, John Davies at Renegade Style. That's a wrap for us. See everyone for the NFP tomorrow. NFP stands for no effing problem. So above that, don't just count your pips, count your blessings. Adios, everyone. See you bright and early for the NFP. Thanks again, John.
Thank you.